So, what is new in the world of exercise, you may ask? As if you did not already know, Peloton is laying off 500 more employees. This follows an earlier layoff of 500 employees 1 month ago. So, why did all of these layoffs come so quickly? And, if Peloton could survive with 1,000 fewer employees than it had, why was it not doing so already? This video continues our coverage of the wave of layoffs sweeping the United States. That seems to be the most popular subject on this channel. What does this mean for Peloton? What does it mean for big tech companies? What does it mean for the economy? And, what does it mean for the future of the United States? But, before we get into all of that, please press the like button and leave us a comment below. We would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos when they are released. Peloton is laying off yet another 500 employees. CEO Barry McCarthy said that the layoffs are necessary to return the company to growth. Peloton did very well during the pandemic. But, since then, the company has been struggling. Cutting 500 more positions amounts to 12% of the current employee base of the company. The cuts, which amount to about 12% of Peloton's workforce. Peloton has already undergone multiple rounds of layoffs this year. The restructuring is done with today's announcement, McCarthy said. Now we're focused on growth, continued. Peloton now has to prove its recent spate of strategy changes, McCarthy added. That includes equipment rentals and partnerships with Amazon and Hilton, McCarthy also noted. Shares of Peloton traded 4% higher on news of the additional layoffs. But, Peloton stock is down 75% so far in 2022. McCarthy became the CEO of Peloton earlier in 2022 when founder John Foley stepped down. Since then, McCarthy has made drastic changes to Peloton's business model. After a pandemic-fueled sales boom, sales growth went negative. McCarthy was formerly an executive at both Spotify and Netflix. He has focused Peloton's business more on subscriptions. Peloton's origins were in a direct-to-consumer model. Now, McCarthy is broadening the availability of Peloton's products. For example, Peloton is installing its exercise bikes in every Hilton-branded hotel in the United States. Peloton is also starting to sell its exercise bikes in Dick's Sporting Goods stores. And, it is also selling its exercise bikes on Amazon. So, those are all pretty major changes to the company and its distribution network. We need to grow to get the business to a sustainable level, McCarthy told the Wall Street Journal. Peloton has still never been profitable. And, Wall Street is looking for profits, earnings and growth. Shares of companies who do not fit this model are getting their stock pummeled. And, with its shares down 76% in 2022, Peloton certainly fits that category. It is still unclear whether the new changes will bring Peloton to profitability. But it looks like a step in the right direction. McCarthy noted that the business model changes and layoffs slow the cash burn rate significantly. And, he also pointed out that Peloton remains extremely well capitalized and highly liquid. McCarthy reaffirmed forward guidance for Peloton to meet its cash flow goals for 2022. I'm feeling about as optimistic as I've ever felt, McCarthy said. But only time will tell. There is a lot of competition in the exercise equipment space. But Peloton has name recognition and a certain amount of brand loyalty. We will see how the company fares in their earnings over the next few quarters. Meanwhile, Peloton is not the only Silicon Valley darling that has disappointed investors. Google and Meta platforms reported decidedly disappointing Q2 earnings. Not surprisingly, both companies revised or revoked forward guidance. Google was still profitable and growing. But top and bottom lines were disappointing. Meta has posted shrinking revenue for 2 quarters and maybe a third quarter as well. Both companies have hinted at layoffs, but not actually made detailed announcements. Meta Platforms management promised cost cuts, hiring freezes and ruthless prioritization. Meta has begun quietly pushing out a significant number of employees. The company has restructured departments and given employees 30 days to find a new job within the company. This enables the company to cut a lot of positions without having to issue pink slips en masse. Analysts expect these reductions to be a precursor to deeper cuts. The company has been cutting its financial guidance for operating expenses for a year now. The long-standing rule at Meta is that employees whose jobs are eliminated will be terminated if they cannot get a new job inside Meta in a month. In the past, only undesirable employees failed to land new positions within the company. These days, employees with good reputations and strong performance reviews are being routinely fired. Meta has about 83,000 employees, which is 32% higher than at this time last year. Google also requires affected employees to apply for new jobs in order to remain employed by the company. Google cut half of the positions in its startup incubator called Area 120. Alphabet has 174,000 employees, which is 20% higher than this time last year. But the United States is now teetering on the brink of recession and the digital ad market has plunged. Realistically, there are probably a bunch of people at the company who shouldn't be here, Mr. Zuckerberg said at a company town hall in June. Meta head of engineering told managers to fire all employees who were coasting. Shares in Meta platforms are down by over 50% so far this year. And the market capitalization of Meta has fallen by over $685 billion since its all-time peak in September 2021. The market capitalization of Google is down 27% over the past 122 months. But not all big tech companies are adopting the stealth layoff approach like Google and Meta. Snap has publicly announced layoffs of 20% of its employees. This comes after Snap grew its headcount by 65% within the past year and a half. Real estate platform company Compass has just announced that it completed its second round of layoffs. Compass has yet to become profitable as company. Compass has invested $900 million in its technology platform. This year, it is clear that Wall Street analysts are valuing profitability over prospective growth. As a result, unprofitable tech companies' shares are getting punished. And all companies are forced to either be profitable, find a merge partner, or die. The window for initial public offerings is effectively closed. That is why some Wall Street investment bankers are predicting a wave of tech mergers later this year. Twilio, another unprofitable tech company, is pretty much in the same boat as Compass. Last week, Twilio announced the layoff of 11% of its employees in a broad financial restructuring. The layoff will affect up to 900 Twilio employees. It comes amid a broad macroeconomic downturn in the United States. The Federal Reserve is aggressively raising interest rates. And the United States is teetering on the brink of recession. But surprisingly, economists are divided on the health of the U.S. economy. A recent Stifel survey of corporate leaders shows that most are anticipating a recession. Another survey from PricewaterhouseCoopers shows that half of all companies expect to lay off employees within the next 12 months. It will be a challenge to return to an environment of stable prices without sacrificing the economic gains of the past 2 years, said Fed Chairman Jerome Powell. Oracle, the worldwide software giant, has cut hundreds of positions but declined to say how many. But, what do you think? Please leave us a comment below and hit the like button. We would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos when they are released. Please share this video on social media. Thank you for watching.